Welcome to the Common Sense Investing, or CSI Show, with Victor McClure and Guy Allard from McClure Capital Wealth Management Companies. Victor and Guy will use their combined 60-plus years of experience to answer your financial questions with their own brand of plain-spoken language and hard-hitting style.
Welcome to the Common Sense Investing Show. I'm Victor McClure.
And I'm Guy Allard, and every time it says 60 years of combined experience, I just think what a wonderful, fun 60 years that's been. What about you, Victor?
I do tell you one thing, all seriousness. Most people don't get to do what they want to do or what they're trained to do. And we've had the luxury to be able to do this for over 30 years apiece.
I'm not positive, but I believe it was Mark Twain that said if you do what you enjoy, you'll never work a day in your life, or something to that effect.
Said, Will Rogers was one of them. Right. But that's why we're, neither of us have ever talked about retirement. Plus, we like spending money, so that's it might be part of it. But today's show is going to be tariffs and college. I know they have nothing to do with each other,
right?
But there's some good information out there to help with kids' college, grandkids' college. There's all kinds of things like that. Plus, all the news this last week were tariffs. So we'll talk a little bit about that.
I know how expensive college is, and kind of date myself a little bit. I remember SMU and all that, $40,000 a semester seemed like a lot, but they were talking on the news just a couple days ago, earlier this week, about kids graduating with $1 million college debt. Now, I don't know if that's a PhD at Harvard or what it is, but I can't even imagine.
Well, people we've interviewed lately, they might have a master's degree working at Target or whatever. Nothing wrong with Target, but they're just not working in the field they went to school for.
No, not at all. When Victor alluded to, we're hiring a couple of interns, and we're going through and sorting through and sifting through all sorts of applications, and we get them from across the country.
I think everybody's employed, but there's so many people underemployed right now.
Yep.
Well, let's talk a little bit about tariffs. Tariffs are when you're importing something and you slap another tax on it or whatever, and so it's got to go into the price of the product or whatever. And sometimes we don't have tariffs on stuff coming in, but when we sell it in their country, they impose a tariff on us.
And the intention of the country imposing the tariff is for you to buy their goods and to charge people that want to import stuff into their country and access their market, i.e. China, to get punished and to get penalized. Everyone has been doing it for a long time, and all of a sudden, we impose some tariffs, and it seems like we're the devil. But Victor, you and I were talking at lunch, whether you believe tariffs are a good thing, and it's going to be short run, a little bit of pain, and we'll come out of it, or whether you think it's absolutely the worst thing in the world, and we're going to get a trade war, and we're becoming isolationists, and all of that stuff. Either way, and I'll tie it back into your portfolio, is your portfolio prepared for what might happen? If nothing else, good, bad, or indifferent, I believe we're going to see a lot of volatility. Because it takes a while for these things to iron out.
And remember, what is the stock market? It's ownership in companies. And these companies import and export material and, products, material, unfinished, everything. So it affects pretty much everything.
And when, Victor, is volatility terrible on your account?
Always.
No. Not if you're trading. If you're a day trader, it's pretty good. If you're withdrawing, if you're in retirement and you're using the stock market, or I should say misusing it to generate income for your retirement and not having a guaranteed income stream, and you have to withdraw 1 month when it's down 10%, and then the next month it's up 10%, well, it's not back to where it was, plus it's less your withdrawal. It's a very difficult time if you're using the stock market for withdrawals.
Just to lay an example, regardless, we're not getting political, believe me. Don't call me political.
Either side of the fence you're on.
We're just talking about a tariff in general. Let's say that we tariff a product coming in the United States. Okay? Well, we tariff 20%. Okay? They're not going to automatically give a 20% discount to anybody here. They're just going to raise the price 20%. Now, that will get them the same amount of profit. Maybe they'll split it in the middle or whatever. But the problem is when you raise the price on something, especially if you jack it up 20% overnight, you're going to have a lot less demand for that product.
Well, but there is a silver lining. This tariff is more of a tax, and once you get something taxed, we know the government has proven its ability to take that money and use it for good things. For our,
right.
No, am I wrong? For the citizens, it helps. It's efficient, effective with the money that it's going to now have.
Well, I was thinking California has a lot of taxes. Their roads must be paved in gold and must be much better than our normal road, right? They're not.
No, they're not.
But it's one of those things. Think about it. I used to live in New York. I lived in Chicago and New York when I was in the military. And I remember here, to build a house costs a certain amount. You can build a really nice house here for maybe $100, $120 a foot, whatever. But when you got those high tax states and more unionized states, you might pay, instead of a bricklayer making $12 an hour, it might be $100 an hour.
Crazy difference.
And so it costs a fortune to do anything. So whether you're liberal or conservative or whatever, the more taxes you have on, the more stuff costs. And that's why a lot of people say, I want to buy only American goods, only America. When I go back to where it was in 1950 or whatever. Well, even when you did that, if you're willing to pay 2 or 3 times what it costs, because it costs more here, there's no question about it. And so there's the pain thing. Like I'm telling you right now, you're buying stuff at Walmart, what, 90% of it made in China or something like that?
Harley Davidson, the parts are, most of the parts, if you buy aftermarket parts, made in China.
If you go to Amazon, which I'm a big proponent of Amazon Prime, good deal. It's almost all foreign-made products. And so that's how the prices get to a certain point, because they're all not only competing within the country, competing globally. And so that's how things come down. I'm not saying I'm yay or for tariffs. I'm just trying to tell you it's going to affect your 401k. It's going to affect your IRA. It's going to affect all your stock accounts. It can affect a lot of different things.
Maybe short-term, maybe long-term,
right.
But what Victor's saying is absolutely right. There will be an effect.
And if it triggers inflation, which it could, that's going to affect everything. Even the money you've got in the bank earning nothing will be affected because you'll have less purchasing power every year.
On a side note, and I know we need to get into the segue and how you can take this information and really make sure that your income's guaranteed in retirement. I mean, that's the real important thing, but they also have value-added tax, VAT, right? And I know in the UK and different places, which is another form of a tariff, right? And that sort of thing. So they keep adding these on, right? Kind of like your gas tax was a little bit, then it's a lot of bit, then it's even more of a lot of bit, to use good English. And it just keeps going up. It keeps escalating. Same thing with these tariffs. We add tariffs. They add tariffs. They already had tariffs. We already had tariffs. I got an idea. What if we just removed all tariffs and just leveled the playing field? Why can't that happen?
Yeah, because they won't do that.
No, it won't happen. But just eliminate all the tariffs.
But like I said, these other countries they did it. Think about it. It's a noble. They're trying to protect their own country's interest, right?
Yep. And their economy, right?
That's right.
That's right.
But they don't like it when we do it. No, wait a minute. We're trying to protect our. No, it's the same. You're the free market people. You got to do it your way. We do it our way.
That's right.
So I'm not saying for or against tariffs, but they will affect everything if they stay long enough. If you get a trade war, trust me. Part of me, I'm a military guy. Part of me says, shove it to them. But the other part says, do we really want to pay? Because we will pay.
And here's the thing. You hear the old adage about shutting the barn door after the horse has gotten out. It doesn't do any good, does it? Changing and adjusting and restructuring and rebalancing and making sure those 3 buckets that we always talk about are perfect. After we get into more volatility, we're already there, right? Since probably, February, end of January, we've seen crazy stuff weekly, daily, monthly. Now is the time. It's coming. We're there. We're already experiencing it. Now is the time to secure things. Don't wait and panic and run and make bad decisions after we're knee-deep into what might be happening.
It does reinforce what we've been touting for 20-something years on this radio show. Your income sources to pay in retirement for at least your hard expenses have to be a guaranteed income source. A dividend is not a guaranteed income source. A bond is, as long as you're with high-grade bonds.
And you're willing to hold it to term.
That's right. You have AAA, AA bonds, they're okay too. You can use those just as well. You got to hold them to term. You don't want to sell them early because you can pay a huge tariff.
And sell it at a discount, right?
That's right. So, but those kind of things you can. Do not use growth or why? Because it's not guaranteed. It could go to nothing tomorrow. Companies I got people said, you don't understand. AT&T's not going anywhere. I said, I agree with you. That doesn't mean they can't stop their dividend. That's an easy thing to do. It ain't going to hurt their dang stock that much. They just stop the dividend.
It's funny in retrospect when we help our clients make sure that the liquidity, the income, and the stock bucket, the inflation hedge is equal. Very rarely do I have to help a client take liquidity. They've got too much liquidity and put it in the stock, or they've got too much income and put it in the stock. It's usually always the other things. Recently, I'm thinking as you're talking, this week I've had to help several people take the money out of the stock. Their income was fine, but their liquidity was low. One gal had a couple $1,000,000, but she only had $20,000 in cash.
Right.
So we had to take, a couple $100,000, something reasonable, right, and put it in cash. So it's funny, the stock bucket seems to be always the one that has too much in it because it's more exciting, right? You have more potential.
Well, it's more exciting, and it hasn't gone down in 9 years, so it's grown the most.
And we've got some great managed stock accounts. We use Fidelity as our platform. The sector, some of them are tactical, and some of them are sector-based, and they adjust on the fly as they should. But you just got to make sure they're right. They're allocated properly.
Yeah, that's one thing about us that sometimes I hear the radio shows all the time that they just do stocks. Everything else is the devil's work. You should never do anything else. Then you talk about people that just do like life insurance, bakeonyourself.com, or annuities. You should only do that. All of them are wrong. There's nothing wrong with any of those things. There's nothing wrong with CDs. CDs are a fine investment. They just don't pay anything right now. That's why now it's not favorable to invest in CDs, but there's nothing wrong with a CD. There's nothing wrong with a bond. Right now interest rates are going up, though, and that bonds might go down. And so you have some issues there. And if interest rates go up precipitously, then you're going to start seeing defaults on bonds we haven't seen in 30 years. Because normally they'll say, well, these junk bonds are pretty strong. Well, they have been the last 30 years because interest rates go down. They can renegotiate their debt, pay off those old ones, and start paying less.
You mean high yield bonds?
Yes, high yield bonds. So when interest rates are going up, they can't refinance that debt because it's a higher payment now. And so that's when you start seeing defaults, and they start defaulting exponentially on all of your high yield type bonds. Remember, high yield is another word for junk bond. It is the exact same bond. It has not changed one iota.
No.
It's like when they came out with life settlements. They said, no, these are different than viatical settlements. Remember, viatical settlements all failed.
That was the technical term, right?
Yeah, they're exactly the same thing. The only difference is they started doing AIDS patients back in the 80s and 90s, right? And now they have a normal lifespan with the drugs or whatever. And then they said, okay, we're not going to do those anymore. So we're going to call them life settlements. They're the exact thing.
It's morbid, right, to think about. And I remember when people would ask us, aside from the not being a registered security and all of that, telling them that, it's not a good idea and betting on people dying, even though the potential's there. I've had many people to counsel that they're not dying on time. They still have to pay in. And so how do you handle that? And you think about what you got to tell them. You got to say, well, maybe they didn't die on time, but eventually they will die. I mean, how terrible is that?
And every year they live, you have to pay more.
Oh, I know. It's just like,
so you're hoping someone is going to die.
Talking about human life. So
that can't be good.
No, it's just terrible to have that call.
I think even if you're an atheist, you think that can't be good, hoping somebody's going to die.
Remember all the people the wholesalers that used to come into our office and try to get us to carry that product and told us how wonderful and how stupid we were and silly for not being on board.
We didn't know. Remember, everything has got to pass a smell test before we offer it. There's never been something we offered that turned out to be illegitimate or anything else. We've never had a customer complaint, either one of us, in 30 years each. So that is not bad. You can't beat, when you do stocks, bonds, and news, everything, that's a pretty good track record.
Yeah.
We've been fiduciaries for 20-something years. They didn't used to have that stuff. It used to be you had a stockbroker. You had a commodity broker, stockbroker.
And it's all about trades.
That's right.
Let me tell you what's happening.
That's right. Then it became advisors, and they are passing that law though that says just the insurance only guys on it can't call themselves advisors anymore, but it's not in effect yet.
Yeah.
So usually it's going to be a real advisor when they say it, because I've heard it from all kinds of people. They'll say it if they do just life settlements or some private investment stuff.
But keep in mind what we're talking about, whether it's the tariffs or the economy in general. There's a storm coming. Doesn't mean the ship is going to sink. Not at all. We're not trying to scare anyone. But as they used to say, you've got to batten down the hatches. You just got to be prepared for it. And the storm may just be volatility. It may be a level net sum gain by the end of the year, but it's going to be volatile. And if you're using stocks right now to generate income and you're retired, It's hard to be absolute, but I would say stop. Now is not the time to do that.
And also, when you're doing the whole tariff game, right? There can be long-term positive effects potentially because it could protect U.S. businesses.
But you got to get through some pain, don't you?
Oh,
to get
a lot of pain. But also, there's not very many companies that don't export internationally of those companies, so that's going to hurt their profit. I'll be honest with you, just economics 101, I don't see much benefit in it. I could see how, theoretically it's going to help our companies, but these are only domestic companies only. Like, what was it? Coca-Cola sells 75% of their stuff overseas.
Yeah.
I think cigarettes are way worse than that. I know not many people smoke anymore, but it's still U.S. companies. It's like 90% of their stuff goes overseas. But McDonald's, same thing, like 70%. It's a huge percentages that you don't realize are out. They're out there. Even with their tariffs, we make quite a bit of money on exporting stuff.
The only advantage I can see to tariffs, and there would be a long road to pain, would be if we put big enough ones on where they eventually would reduce or eliminate theirs if we complied and did the same. Right. But, who knows when and if that would happen.
Oil prices are coming down a little bit. They were going up a lot. People don't realize the world. I ask this question to a lot of people. What's the largest producer of oil in the world? Everybody always tells me Saudi Arabia.
Right.
It's the United States. Who's the second largest? Russia. So we just use so much of it.
Yeah.
So we are a net exporter now for the just recently in the last few years, but we use so much that even though we are easily the biggest.
I think those offshore reserves that they've been finding are just ginormic, to use a
the Saudis got so because they were able to get it out for about a tenth the price of us. And they've been storing it for.
That's right.
So they've got tons of storage, but we still produce more, and so does Russia. And so, like I said, I'm not a big fan on tariffs or anything else, just because I'm a financial guy. I'm trying to look out for your finances. I don't want the stock market to drop 40-50% because it always overdoes it.
Even if it goes right back up 40 or 50%,
that's right.
It's crazy.
It's too much. It scares people because it has long-reaching effects. Everything is kind of interconnected. It'll affect real estate. It affects everything down the line. There's one thing like that people don't realize. It's called the wealth effect. If your house is going up in value, even if you don't have any cash, just the value of it, you have a wealth effect. You feel better, and you'll spend more money on Amazon, at the grocery store, at Best Buy. That is a known fact. You'll buy more homes. You'll upgrade your home. Whenever that stops happening, you don't feel wealth effect anymore.
It's like stocks. If you start with a $500,000 basis, it's not worth $1.2 million, even though you haven't captured it. You've got $1.2 million, right?
That's right. So there's the actual effect of tariffs and things like that. There's also this the subconscious effect or the psychological effect. Sorry, I couldn't think. The psychological effect, and all of those are real because all of them cause volatility, and volatility can cause panic. And then you're going to overdo it. Like the market went down 50% twice last 18 years. That was way overdone. It should have gone down some, but not that much. And so people ask me, you think it's going to go down that much this time? I find it harder with all these companies having so much more cash than they ever had. They have more cash than they've ever had in history right now. Banks do too. So it's a different world than it was in 2008 or in 2000. But will it always overdo itself? Yes, it will. It goes up too much and goes down too much. That's the nature of it.
The best piece of advice we could share with you is just be prepared like the Boy Scouts. This week, I've heard two well-known economists, sharp guys, all the credentials in the world. One says that this year the market's going to go down 40%, absolutely. The other one says the Dow is going to double in 5 years. Both sharp guys. One of them may be right, who knows? But you can't listen to talking heads. It's like getting a political review. If you're conservative, you listen to certain stations. If you're liberal, you listen to the others. And it's self-affirming, right? You get the answers that you want.
You get their confirmation bias.
Same thing with the market. And if someone tells you they know what they're doing and the state of the market is going to double, or if someone tells you to run like hell and get out of it because it's going to go down, they don't know. It's just their best guess.
That's right.
Be prepared for both circumstances, and you won't have to sweat it.
Remember, if I knew or they knew what the market was going to do, they wouldn't be on the radio, they wouldn't be on television, they'd be on one of their many yachts in Tahiti eating grapes from native girls. You've heard me say that before, but whoever knows what the stock market's going to do, like these Bitcoin people or whatever,
right?
Nobody knows, period. That's where the gamble is.
I heard Bitcoin's going to go from 7,000 to 25,000 this year. Who knows?
And I've heard it was going to zero. Saying that, it's worthless, it's garbage. Well, whatever. I mean, who knows? All I do know is if you take put your affairs in order, you don't have to worry about stuff like this. Or you can worry, but it's not nearly as bad. You know your bills will always be paid. And that's why we always recommend take advantage of our no-cost, no-obligation retirement plan. Less than 5% of people have a written retirement plan, and the ones they have are terrible at best. They just don't tell you anything. I need to know, if the market doesn't make anything for 5 years in a row, am I going to eat cat food when I'm 80? This will tell you everything. It's the most comprehensive plan. There's no cost or obligation. Call us at 972-715-2424. Again, 972-715-2424. You can always go to our website, ilovemyretirement.com. Remember, there's past shows on there. You can listen to all those. There's a bunch of videos. You can see our ugly mugs on there.
Yeah, speak for yourself. Hey, I would like to add, though, Vic, the Retirement Analyzer, just to kind of give you a flavor and an idea. Basically, it takes your assets. If you got fixed, guaranteed stuff, be it annuities, bonds, CDs, if you've got liquid stuff in the banks, if you've got stocks all over the place, individual stocks, mutual funds, it takes them all. It takes your income from Social Security, any pensions that you have, teacher retirements, any of that stuff. It takes what type of expenses you have now and what you project to have. Now, that's the tricky part, right? It's always hard to
factor in taxes to the penny.
And
inflation.
Every penny. And each year, and a little moderate inflation, 2%. We don't run 2.5%, 3%, any big numbers, but say 2%. Each year through your retirement, we can show you what amount of money is coming out of each and every account. As Victor said, what your taxes are those years. And it just sheds light. It's good to know.
It factors in the taxation on your Social Security, the taxation on your RMDs, or required minimum distributions from retirement accounts.
You'd be surprised how many people don't know Social Security is taxed.
No. Well, they said when they come out with it, we will not tax it.
Yeah, that's right.
Then they tax it anyway. All right, let's talk a little bit about college planning. There's something like called a sandwich generation that we're in now, where people are living longer, and they're also having kids later. Also, a lot of millennials won't work. So grandparents are taking care of their kids, too.
Or at least they won't get their own place.
So what they're doing is you're taking care of your kids and your parents. This has happened a lot. And what happens is people are using all of their retirement savings to do this sometimes, or they can't save like they should. You should always be maxing out your 401k. Always. But they can't because they got to take care of this stuff. The problem is, you do all that stuff, you're a saint. I know. I've done the exact same thing. Guy knows. I've taken care of more people than I ever should have. But, you can get a loan for college for your kids or your grandkids. They can get a grant. Try to get a loan for your retirement.
That's right.
There is nothing that's going to happen. You're just going to be sitting there in some crappy little place because you couldn't afford it, because you couldn't save because you were taking care of everybody else. Now, I get it. That's what we want to do. But remember, there's some really neat things. There's a 529 plan that you can put away for kids or grandkids. It can grow tax-free. They can go to college. At least that tax-free growth is worth something, right? Hopefully it'll grow.
Right.
You've got like the Hazelwood Act. If you're a Texas veteran, this is a real thing that 90% of veterans I talk to don't even know. You get 150 hours of tuition, 152 hours tuition in a Texas university for free. And that pays for not just tuition fees, everything. And so that is a really neat thing. Personally, I am a Texas veteran. I didn't know about it until my first child was already at about 8-9 years of college.
That's when you found out you were a veteran.
Yeah, no, that's when I found out I could have got it free, or at least part of it, right?
I got it, right.
No, my son spent 8 or 9 years in college, and he's not a medical doctor. I'm just saying. But
the other thing, too, if you're taking care of folks and kids, even if your folks have the money, or most of it to take care of themselves, it's demanding. It does, your work may suffer a little bit, the family may suffer a little bit. We talk about the psychology and the emotion of investing. It all plays a role, and it makes it a little bit more difficult for you. If your affairs are in order, again, 3 buckets. If everything is allocated properly and humming along, it frees you up and it reduces stress.
I mean, that's what we can do to help. Because what we could do is you can have a plan and say, hey, if you do this, you will not live in the same place you're living now. You will not have the same lifestyle you're living now. So maybe you think about it for a second. Like I said, I've done this to my own detriment to many relatives. I'm going to let you know. To many of them. Still doing it.
Even step relatives.
Exactly.
And adopted kids. And not adopted kids.
It's just
You've
the way
got a
it
big
is.
heart.
But you've got to think about yourself at one point. At one point, you got to think about yourself and you're saving for retirement, all that kind of stuff. It has to come from it because nobody's going to loan you money to retire. There are things like, reverse mortgages, stuff like that, but you can't rely on that. A reverse mortgage is not that great of a deal. Don't get me wrong. Use it if you have to use it.
And once you're down that path, how do you you can't get out of it?
No, I mean, you can if you all of a sudden have some cash, but you don't make money anymore because you work.
Exactly.
So it makes it difficult.
And you only get 60 cents on the dollar or some number.
Yeah, it's not great.
It's not a great deal.
No, it's not great. But, hey, you need it. You've got a $2,000 mortgage, and this will make a zero mortgage. That's,
There you go.
You can have steak once a month or something instead of beans and bologna every day, whatever. It's worth it. So you got to use that stuff. But there's all kinds of different grants. There's the Hawkins Act, like I said, the 529 plan. There's all kinds of there's another thing. If you're making under, I think it was $100,000 a year, and you do the Texas Tomorrow Fund, which is now called the Texas Promise Fund.
Right.
They'll match some of your contribution, but you got to make under a certain amount. But that is a pretty neat deal. In other words, let's say you did the Texas Promise Fund, like $400 a month to get your kid through college or whatever.
Right.
They'd match some amount. I don't know how much it is, but they'll match it if you fall in these categories. Most people don't know about that. I did take advantage of the Texas Tomorrow Fund with my oldest son, and it basically locks in today's college. It used to be called the Texas Tomorrow Fund. Now it's called the Texas Promise Fund. Well, what happened is it was guaranteed then. It's not guaranteed now, but the universities have said we promise to do it.
Oh,
so I guess they legally don't guarantee it, but it's promised, and they said no, it has worked to this point. I'm telling you, over the 8 or 9 years my son went, plus I did it when he was like 12, something like that.
Started.
I saved a fortune because during that period of time while I was going to college.
You locked in the rate.
Yeah, tuition doubled. Yeah. But I was paying the rates from 10 years earlier. You can still do that. And you can actually have a set budget. In other words, kids, grandkids, it's $400. If you start early, it's cheap, way cheaper, right? Start at birth. Start one of them things for $100 a month. And you've got a Texas. Now they can't go to University of Hawaii, but I'm okay with Texas. Nothing wrong with Texas.
That's right.
But send them to it. You can do that. Plus, if you make under a certain amount, you get a matching contribution. I don't know how much it matches, but it's supposedly pretty generous. On top of that, to cover the children. And so there's a lot of things you can do, but you can't leave this open thing where I'm just going to pay for it monthly. Because right now it can be $50,000 a year. Like. Some people have the money, and more power to you. But a lot of people don't have an extra $4,000 or $5,000. Now that's what happens. They're in the second year of college. You're paying $4,000 or $5,000 a month you can't afford, right? And then you got a long-term care event comes in. Now you got to pay all those bills plus your home bills. They're the same, but now you got a $7,000 a month nursing home bill to pay for. All of these things you got to take care of. You got to have contingency plans, and so that's why I tell you. Exhaust every resource when it comes to sending kids and grandkids to college. But if you can do it, think it forward. People never do. But think forward. You can get it for pretty cheap. You start at birth. Maybe $100 a month. I don't know the numbers, but $100, $200 a month gets them through college. And so that's what that's what things you need.
As always, the earlier you start, the better off you are,
That's right. Now, a lot of people don't think about it till they're about 18. It's going to cost you a lot more. But at least you'll lock in tuition.
It's like wanting life insurance at 70.
Happens all the time.
Yeah.
Well, that's our show, folks. I want to thank everybody for listening to Common Sense Investing Show today. If you have any questions or would like to take advantage of our no-cost, no-obligation retirement plan, Social Security optimization, or just like a portfolio review, don't hesitate to call us at 972-715-2424. Again, 972-715-2424. You can always go to our website, ilovemyretirement.com. I'm Victor McClure for Guy Allert. We always appreciate your time.
The preceding show is paid for by McClure Capital and is for informational purposes only and not a solicitation or representation of any particular investment product or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives in making any financial decisions. There is never any guarantee of future success or performance.